to the data dependency of the Fed. I'm sorry, they're going to be more data dependent, period.
It is a mystery, Tom. Mysterious, like getting locked into Shanghai Disneyland with 33,999 other people. Can you imagine that, Tom?
No, I can't.
Locked in at Shanghai Disney, one COVID case.
Just unbelievable.
Unreal. Did they keep the rides operating?
Don't know.
Do we know?
Don't know.
Just
Don't think it's funny, John. I think it's like
I'm not
really
laughing
ugly.
about it.
Yeah,
I think it's
really
absolutely
ugly.
ridiculous. I'm just trying to work it out. Could you imagine that happening in America, Lisa?
No.
No. This is short and sweet, isn't it?
Fantastic.
Thank you. That's your cross-asset price action. 93.95 on iron ore. Let's get you some single names this morning and say good morning to Romain. Morning, Romain.
Hey, good morning, guys. Let's turn to earnings. Of course, busiest week of the earnings season for the S&P 500. This is the busiest day. 51 companies reporting out of the S&P. Fives are already out of the gate. Shares higher here in the pre-market by 4%. This is all because of that COVID-19 vaccine. $24 billion in sales off that vaccine alone in the most recent quarter, guiding to $36 billion on a full-year basis, well above what the street was looking for. And this is important because all of its other drug franchises, they actually saw a slight decline in revenue in the most recent quarter here. So really the big growth driver here, at least for the short term here right now, is that COVID-19 vaccine. Clorox also out with earnings. Remember, a big beneficiary, of course, of the pandemic as everyone was buying cleaning supplies. Believe it or not, those sales holding up, $1.8 billion. Again, above street estimates, shares up 2%. And Under Armour, a real big surprise here, coming in 74 cents on the EPS. That's about 40% higher than what the street was looking for. Those shares having a phenomenal day, up about 9.5%. Flip up the board, not having a phenomenal day is Chegg. That's the big online education company. They came out with earnings. Those shares down 32% right now. The company basically said a huge drop-off in enrollment for the fall semester year. This is a stock, of course, that had been a big beneficiary during the pandemic, had more than tripled in the year leading up to February. It peaked in February. That was the record high. It was already down about 40-something% since then. Add another 31% today if this holds through the close here. A pretty phenomenal drop here from that record high. Arista Networks, a big beat and raise here, up about 20% here in the pre-market. And keep an eye on DuPont. The share is slightly lower here. They came out with earnings. They actually cut their forecast here. That's putting some downward pressure on the stock. But it also announced a pretty interesting acquisition of Rogers. This is basically a deal that allows DuPont to sort of enter more into the clean energy space here, the engineering firm that it's going to be buying here, though the share is down slightly. It's a $5.2 billion deal, all cash.
Romain, thank you so much. Greatly appreciated. On the equity market here, and again, red and green on the screen, NASDAQ a little bit south this morning. Right now, as we continue our coverage in Scotland of leaders greeting, including Prince Charles among the attendees here, and he has been committed to this for ages, is someone as well committed. She is from Eastern Europe, where climate change is incredibly important. For those of you on Bloomberg Radio right now, Prince Charles speaking to those gathered in Glasgow, Scotland, all sorts of symbolism there. But right now, our Francine Lacroix with the managing director of the International Monetary Fund.
Thank you so much, Tom. Yes, we are absolutely delighted to be joined by Kristalina Georgieva of the IMF. Thank you for joining us. I know the IMF has been instrumental in helping with climate finance and also giving aids in these public-private partnerships to make sure that we deal with sustainability. Are you confident that COP26 is not just a talk shop, but that will achieve meaningful changes?
I see three reasons to be confident. One, finally, net zero by mid-century is embraced by a vast majority of countries, 135 and counting. Two, because this time more of the speeches are about what we can do, not what about you should do. And that taking responsibility matters. And three, keep your eyes on tomorrow, Finance Day.
Yeah.
Just to give you the number, we are proud that climate finance last year jumped by 50%, but jumping by 50% it is only $130 billion out of 49 trillion. This is 1/4 of 1%. Tomorrow, I expect to see many of these trillions grabbing this opportunity to move to net zero as a chance to be profitable and green.
But at the same time, the U.S., I know there are initiatives with methane, but actually the president is not coming with new solutions. China's not here. We don't have any new solutions from China. And Brazil is, doing a U-turn, but actually we go back to what it was like 3-4 years ago. Can we really achieve it without more from these countries?
We need everybody on board. We need all hands on deck. And we have to continue to pressure countries to come around. And actually, when we talk about what is worrisome, to me, the most worrisome is this decade.
Yeah.
If you look at where we are on the emission reduction by 2030, at the pledges we have today, nowhere close. We are maybe 1/3 to 2/3 close to the pledges that we need to get our chance to keep temperature at below 2 degrees and even better 1.5. So more attention to this decade is what is necessary, in addition to bringing these less willing parties on board.
What do you worry about in the world economy? So there's inflation. It's coming. We're not sure whether it's temporary or not. There's supply chain issues. If we don't have a smooth economy, this will turn back. Actually, it's back on climate change.
Of course, if the economy starts rolling back, this would be tampering appetite for climate investments among any other investments. So let's look at the economy. What is the problem? It is still that part of the world is emerging from the pandemic very strongly, and another part is falling behind. This divergence causes interruptions in supply chains. We expect, unfortunately, these interruptions to continue into mid-22, maybe even further, and they are putting pressures on prices. We are hopeful that these price pressures are going to be temporary. We also know that central banks have the tools to deal with them.
But what if they're not transitory, these inflationary pressures?
If these pressures are there, central banks are going to take action, inevitably. We have seen already Canada doing some of it. In emerging markets where inflation is real and it is more systemic, rates are going up in many places. The problem is that if you take interest rates up, the solution for some would be a problem for others, especially for emerging markets with high levels of dollar-denominated debt, for the corporates that are on the big mountain of debt. So preferably, we should see tempering inflation. And how can we do that? Well, focus on reducing this divergence. Vaccinate the world so we can see production everywhere stepping up.
We're slow to that. Is it going to be stepped up significantly, or otherwise, if we're creating this two-speed world, but also within economies, a two-speed economy, what does it mean for actually the future in terms of populism, in terms of some of the policies put in place?
It is going to be very problematic on many counts. For decades, the world was converging. Poorer countries were getting richer, poorer people were getting wealthier. When that breaks, and right now it has broken down, of course we risk more tension and affecting the social fabric in many, many places. Remember 2019? What did we have? Protests in Chile, in Paris, all over the world. If the divergence continues, we are going to see more unrest. How can we overcome it? Well, vaccinate 40% of all people in all countries, at least by the end of this year, 70% by mid-next year. Do we have the vaccines for that? Yes, we do. But we are not distributing them yet in a way that would make that difference.
What about tax? Do we need to change the taxing system to make sure, again, I mean, this is also the problem with climate change, is that you can have the best will in the world, but money needs to transfer from the richer countries to the less rich ones.
We do have to look at taxation that helps us to reduce inequalities within countries and across countries. We can do it without this turning into a major burden, because even incremental change in more progressivity in taxation can fuel more money in the right place. We also can improve the quality of spending. Make good use of the money you have in your hands.
And the IMF board said there wasn't conclusive evidence in wrongdoing, actually, with some of the allegations against you. Is there concern that actually the staff have turned against you? Do you worry about your credibility with the staff?
No. Let me first say that I'm very grateful to the membership. They gave me a chance to present my side of the story, and they, on that basis, voted full confidence. And then we had great annual meetings with fantastic support for the agenda of the IMF. Of course, staff was and continues to be concerned. That is not a minor issue whether we have full integrity of the work we do. Fortunately, in the fund, yes, we have high respect for the quality of our reports. I have engaged with the staff. We had 2 town hall meetings. I have answered many questions people have on their mind, and of course I will continue to do so.
Have any members said that they're concerned about what's happened?
Of the membership,
the IMF board, yeah, on the membership.
Well, at the membership, in the end, the vote was very clear. One of support for me to continue to do the important job we have in front of us, including for the IMF to play a critical role on climate because it is macro-critical. It affects macroeconomic and financial stability, and climate action is our chance to create green jobs and green growth.
Kristina Georgieva, thank you so much for joining us today. Of course, that was the MD of the IMF. With that, I'm going to send it back, John, to you in New York, and of course, we'll have plenty more from Glasgow throughout the day.
Francine, thank you. Looking forward to it. An important conversation there, Tom. A signature issue for the IMF Managing Director after the IMF Managing Director reportedly, according to a report that we put out on October 8th, tempered some language around climate change for Brazil after Jair Bolsonaro, the Brazilian president, objected to it, Tom.
Yes.
That's an ongoing conversation still.
Ongoing, and to see how she manages her way, interview to interview and meeting to meeting out of this will be closely scrutinized.
I imagine she'll be pressed a whole lot more, Tom, through the next couple of days. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Equity futures unchanged this morning. The Federal Reserve about 24 hours away. From New York, this is Bloomberg.
Stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked about other things. Now that's moving to become mandatory.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Security selection will be critical. If you have 3% inflation with very strong economic growth, I think your cyclical stocks will do well. The financials could do well. I think the stocks that are going to be most challenged in an environment like that are the companies who hope to make money in 5 or 10 years.
Ron Temple there of Lazard. It's the Jay Pawlowski trade over at TPW. He'll take 3% inflation with 4 to 5% real GDP.
Yeah.
They'll take that, Tom. In New York City this morning, good morning. Tom Keene, Lisa Bramett and Jonathan Ferro, your equity market all-time highs into Tuesday. Equity futures basically unchanged. 10-year yields 155.05. A stock to watch is Tesla in the pre-market. Down and down pretty hard early on. We're down now by about 4% or so after a monster rally. Through October, up something like 50% into November. Elon Musk overnight, Tom, saying the following: if any of this is based on Hertz, I'd like to emphasize that no contract has been signed yet. Tesla has far more demand than production. Therefore, we will only sell cars to Hertz for the same margin as to consumers. That tweet, Tom, sent last night, yesterday evening.
Well, you can take your Tesla and go out into the countryside, John, and buy bushels of wheat. That's emotional for a lot of the world. John, wheat's spiking up over
like the
$8. No, $8 a bushel. I mean, come on. You go up to Accord, New York, you go to the Accord market, and you buy your bushel of, Weetabix. John, what are Weetabix?
Weetabix, Tom. You never had Weetabix?
No, I never had
It's like
Weetabix.
a breakfast cereal.
I've had Weetabix.
Get a couple of
were you
Weetabix,
forced
put it in a bowl,
to eat it as a
put some
child?
milk. Not forced. We used to put sugar on top, Tom. That would make it work. I would enjoy that.
I thought you'd put Guinness on it,
Well, Tom, I was 8 years old. It's a little bit early for the Guinness.
A little bit
The
early.
pints of Guinness came later on in the teens.
Came on later. Okay, let us start here. And we do it in the backdrop here is of transitory moving into some form of inflation dynamics. It is a jumble, a world of jumble. And to provide clarity here, James Sweeney. James, as you know, in Coventry, the United Kingdom, there are phenomenal Italian restaurants, and they're serving you, say, bowls of spaghetti, but it's weird spaghetti. How weird is our economic spaghetti right now?
Yeah, I mean, the economic data are doing things that they don't usually do a year after a recession. You're seeing all sorts of strange shapes. And so I recently wrote that, if you pick your favorite indicator or two and you look at the line chart, it looks like a weird piece of spaghetti doing something that you don't expect. And if you over-focus on one or two things, whether it's inflation or industrial production or services spending, you're likely to make a mistake, because the key here is to not focus on the data piece by piece and compare it to past recessions. It's to look at the whole bowl of spaghetti and say, this is a pandemic, this is special, this is different. Right. Why do the data look like this? It actually, I think there's a very coherent story to why the data looks like this. And what we have to figure out next is what normalization looks like.
When is the normalization? I get the idea of the study of what, but I would suggest the real mystery here, including for the Fed at their meeting today and tomorrow, is the when of it. We've lost complete track of the x-axis.
Yeah. Well, I think on certain items we know, actually. For example, on social distancing is down significantly. So spending on services is not completely back, but it has largely normalized. Spending on goods got to an extreme level this spring and is now falling in volume terms, but is still very high. It will continue to fall. And I think inflation, the high inflation that we're seeing, is largely about that overshoot in spending on goods, which was fueled by savings from not spending on services as well as stimulus. And a lot of these so-called supply shocks we're seeing is actually demand exceeding, normal capacity in many businesses. So the supply problem is often that there's not enough supply to meet demand for goods. But the goods are a weird piece of spaghetti, which have overshot hugely in the spring, are still high, but will be coming down as we consume more services and we get farther away from those stimulus checks. That's going to free up some capacity. That's going to alleviate the inflation issue. And we're going to see goods inflation, the worst part of the inflation problem, coming down sharply in the middle of next year. And we, I think, can be pretty precise on that timing already.
All right, James, this is what Francis Donald was arguing earlier from Manulife, basically that the Fed will be committing an error should they hike rates 1 or 2 times as the market is predicting. The one counterpoint to this is the employment cost index, or I should say one of the many, but probably the strongest of late. What do you make of the idea that wages, at least according to this indicator that the Fed watches closely, are rising at the fastest pace on record?
Well, it's not really the fastest pace on record if we look at a longer record. And they're not actually rising faster than inflation. And then when you look at strong productivity, workers are certainly not capturing their, the proceeds of their productivity in a way where their real inflation-adjusted wages are exceeding that. So the wage picture is not as strong as it looks. The labor market has some slack in it, but I have confidence that it's going to be coming back. And I would say that even though the labor market is not as tight as it looks, except in some specific industries, that doesn't mean that the Fed shouldn't be looking at hiking here. I mean, I think they're going to wait a while. I think there are going to be some further wobbles in the data. Next year, we'll see periods of weaker industrial production, weaker retail sales, and falling inflation. But we're going to see stronger GDP. We're going to see stronger services spending. And we're going to see less distancing, I hope, and better business investment. And therefore, it's going to be a debate. It's going to be a big debate. Whether wages and housing inflation can be strong enough to sway that debate in favor of early hikes and aggressive hikes, that's something that the market is now pricing for. I think the market is being a little bit over aggressive at this point. But I think as we go through next year, we have to watch how this normalization plays out. There are still things that we don't know yet. But the wage picture, the labor market picture right now does not scream hike now. It might in 6 months. It very likely will in 12 to 15 months.
Getting back to normal. What is normal? I don't even know anymore, James. I think the average on the Fed funds rate over the last 20 years is about 1.5%. It's not normal anymore, is it?
They think the long-term Fed funds rate is 2.5%. The market seems to think it's more like 1.75. So that's the normal they're talking about. I'm not sure that normal will turn out to be correct. Yeah. But when you're looking at the regular data, I mean, retail sales, like I said, exploded relative to very, very stable historical trends that often look just like a straight line for years in a row. You're not back to those trends yet. And being on those trends is normal. You're way above those trends in terms of consumer goods spending. You're below the trends in terms of services. You're above in terms of inflation. These things are very likely to tend to normalize towards old trends, give or take some underlying changes. And those normalization paths are likely to be the dominant force in what you see in the data. So the question is, will the people focus on falling retail sales and things like that, or will they focus on rising services spending? And that's going to be the two sides of the debate in 2022.
Hey, James, good to catch up. As always, James Sweeney there of Credit Suisse. Tom, demand not the problem.
Well, we'll have to see. It's open to me, John. We'll have our Fed coverage tomorrow.
Looking forward to it. Full coverage on Bloomberg TV and on Bloomberg Radio. This is Bloomberg.
хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, ну, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
Тоже это не про, в чем дело-то. У нас же экспериментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. Ну, то есть второй будет проще.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The market is certainly testing the limits of the central banks.
I think the central banks are always behind markets.
I'm hearing a lot about this fiscal tightening, and I'm not sure I buy it.
Chair Powell has slowly morphed from being ultra dovish to a serious tint of hawkishness.
Even though the destination is not too far away, I think the Fed will be relatively deliberate about raising rates.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, Tom Keene on radio, on television from our headquarters on Lexington Avenue in New York City. John, we're back in the office. We're seeing many other people get back to the office, and they're greeted by these turmoils of 2021 and this November.
We can talk a lot about the turmoils, Tom, but the bottom line is demand is still good. You saw that in the industry commentary in the ISM yesterday. I'll read you some of it. Business remains strong. Customer demand remains high. Demand continues to be strong. It was echoed throughout the whole thing. You can focus on prices paid, Tom, but underpinning that is really solid demand into 22.
We're going to do the interdependencies here in a moment with Jeff Yu of BNY Mellon. We're really thrilled he could join us to start this hour. But John, what part of the turmoils has your attention?
Front end of the yield curve. Without a doubt, Tom, the RBA has validated the move overnight in Australia. In the United States, remains to be seen what happens tomorrow, and then it's on to the Bank of England on Thursday. They've encouraged the repricing of the move at the front end of the curve. Tom, that's where it's at globally, pricing in higher interest rates and pulling forward that view in the last month or so.
All of the different turmoils. We talked, Lisa, earlier with Amesh Adalja about Shanghai and 30,000 people sequestered at Disneyland. Bring that over to better pandemic statistics here. Bring that over to a president who has to return to a fractious Washington. I'm sorry, uncountable turmoils.
And bring it over to the anti-forecast of Francis Donald. How do you sort of square the bifurcated nation of the emergence from a pandemic with what's happening in a global economy when you do have China with these self-imposed restrictions that are probably, at least in parts, going to get worse as you see certain upticks in the virus?
Commodities, hard, soft. John, you mentioned iron ore early. Why?
Cutting back on steel, Tom. Iron ore sub 100 a ton over in Singapore. It all makes sense. They want blue skies in China, Tom, for the Winter Olympics. It's the demand piece in China that I don't quite get right now. We've talked about the robust demand in America. That's how we started this hour. In China, it's a very different story. And Tom, we talked about the story that came out overnight. China urging people, local governments, to stockpile necessary goods, Tom, food, into winter. What is going on in the world's second largest economy? I don't have a clean read right now.
I have a clean read. It's called wheat. And John, I totally agree with you. That was an incredibly important headline. And you see this, folks, in the sauce, whether it's rice, wheat, corn, whatever. They are coming up wheat over $8 a bushel. John, let's start the data check there. I got one data point this morning, $8 a bushel for wheat. John, in my span of commodities, that's unimaginable.
I'll get to the major cross-asset themes outside of wheat. I'm with you, Tom, though. It's serious. It's serious. Equity futures unchanged on the S&P 500. Yields unchanged, too, at 155. Euro-dollar not doing much at 116. And crude lower 1% at 83.20. It's the move on bonds, Tom. We just settled down going into tomorrow. There's even a rally in the Italian bond market this morning. BTP yields a whole lot lower. But that's going to be the focus into Chairman Powell tomorrow afternoon.
Now let's get right to it, folks, and bring in Jeffrey Yu, of course, with BNY Mellon, and we're thrilled at his knowledge of the interdependencies, the linkages of these turmoil. Jeff Yu, the same question I asked John Farrell. What is the thing you're watching right now, the many turmoils that are out there? What's a singular market dynamic that matters to Jeff Yu?
I totally agree with him. It's a front-ender fixed income vol. And I'll just touch on one word from the RBA overnight, plausible. So the RBA said, well, rate hike in 2024 is plausible, 2023 is plausible. Everything is plausible. Well, if everything's plausible, then it's a free-for-all. More volatility coming through in the front end. And let's start with the Fed, and then we'll see what the BOE can come up with.
Hey, Jeff, it's different for the RBA to do it. They've got the luxury of maybe saying things like that. Can Chairman Powell say the same thing?
No, absolutely not. And he knows that front-end volatility in the US curve, and that will tighten global financial conditions. And probably that's something that you don't want to do right now on balance. It probably boosts the dollar, but that will tighten financial conditions for the US. So they've got to be very, very careful about the messaging. But the Fed has the luxury of being a first mover. We've been talking about normalization and inflation, then stagflation, but this has been a process since March, right? Whereas the RBA has been a more recent phenomenon. So he can just sort of drip feed things into the market, and hopefully things can calm down a bit. But it's going to be a tricky game plan for all of them up ahead.
Jeff, I said overnight the RBA validated the move at the front end. The Bank of England encouraged it. Hugh Pill, the chief economist over on Threadneedle Street, is saying this one's a live meeting. We've been burnt by this kind of language before, Jeff, by the so-called unreliable boyfriend, Governor Carney. Is this actually a live meeting on Thursday for the Bank of England?
It is a live meeting, but for the wrong reasons. Instead of talking about the economy and also monetary policy, it's become a live meeting testing the Bank of England's communications strategy, about the credibility of communications. That shouldn't be what monetary policy is about. But on the other hand, given communications already is a part of monetary policy, you could argue, well, the BOE has every right to actually focus on this. So on balance, probably they will move just to validate things as well, but I don't think it's the right step. The BOE has the time. They can afford to wait. Why they're not, I'm not sure why.
Jeff, we're talking about the bond market, and yet stocks have remained incredibly resilient with this backdrop of volatility. And just to give a sense of how much it's increased, if you look at the implied volatility index, the MOVE, the Bank of America Merrill Lynch index, it's risen to the highest since the end of that March 2020 disruption that we saw. Why are we not seeing the same volatility in stocks? Why has there been no bleed over to risk assets?
I think there are two reasons, especially for the US. So firstly, this new round of movement driven by the front end. I think that's where we always expected some degree of volatility. So there's no steepening in the curve, right? I think more people are wondering, why we're actually not seeing any moves higher within the 10-year. So that actually, if you consider equities or equity markets, they're just perpetual duration bonds, then there isn't too much to worry about there. Secondly, I think it's US specific. We talk about margins within equities. So when you have high CPI, it's a good indicator of good demand, good wage growth. That starts to offset some of the margin erosion because you can pass on prices. If you look at China, if you look at Europe, far less capacity to pass on prices. So I think on that basis alone, US equities can continue to outperform.
For how long? What's the trigger to end this?
So the trigger, so one of two things. One is if wage growth and demand growth within the US starts to collapse and you lose that ability by US corporates, especially corporates more focused on the US rather than the global picture, to pass on those price gains, then we have a problem. And I think that will be reflected in the yield curve as well. And on the other hand, I think one of those other banana skins, if China within the next quarter or so doesn't show any additional signs of pickup, then I think the global economy will have a problem heading into next year.
Jeff, the banana skin, the mother of all banana skins, is leverage. We are going to institute leverage into this volatile moment, all the turmoils we've talked about. What's the VAR reality forward, the value at risk reality forward? How many people are going to lose how much money?
Well, then we have to look at credit spreads, right? And the first derivative, well, that's one of the first derivatives of any steepening in the yield curve. So the other banana skin is if communication is wrong, if for whatever reason terminal rates go up, if trend growth goes up thanks to investment or just genuine household growth or anything like that, then credit will have an issue. You talk about who's going to start to lose money, who's been funding US credit over the last few years. In addition to high savings rate within the US, it's the Asian investors, it's global sovereign wealth funds, those asset pools. They may get burned, but at the same time, they have higher staying power as well, a wider stop loss.
So you're advising those sovereign wealth funds. They're leveraged up. They're the funder of immediate resort, I guess I should call it. What do you say to them about which spread to watch? Which is the part of the curve that is their tea leaf to know they're in trouble?
Well, firstly, I think we have to look at what's going on within the 10-year right now, because the 10-year is your best benchmark for where people think terminal rates are. And then if you go further, what are the 30 years? What are the 30-year forwards, I'm saying, if we really want to look for that, the Wixelian rate, as people call it. But also, don't forget Europe, right? Europe credit spreads, I think Madame Lagarde knows that is sort of a mandate for the ECB to target credit.
This is too important. You just mentioned Newt Vixel and the Wixelian rate. Okay, let's go nerd right now, Jeff. How can you judge the dynamics of a Wixelian rate where negative yields are?
Well, that is going to be heavily contingent on, where the inflation trajectory is, from the household side. If that can come off, then in real terms, then you're going to get an upward drift, right, in real rates. Secondly, what's trend growth? What's productivity growth in the UK? If you look at what's dragging down the Wixelian rate right now in the UK, it's productivity. Is productivity going to rise in the US thanks to tech, thanks to government investment? If we get that spending binge through in the US, then you can start raising things again. That's when credit might be a bit nervous. So again, the Fed's got its hands full for the time being, but the market, if you look at what the US is telling you, the 10-year is not expecting any rise in terminal rates anytime soon.
Jeff, I've missed you, mate. It's good to see you, and great to see you in the office as well. Thanks for being with us.
Absolutely, I've missed this place too.
Jeff Yu of BNY Mellon, thank you, buddy. Looking at some news elsewhere, Jeff pointing out China. Let's just spend some time on China. A report this morning from several outlets, Tom, that Yahoo has shut down its services in China with the following quote, "In recognition of the increasingly challenging business and legal environment." Not the first to do so. Tom, China for a long time said it was opening the doors to foreign companies, and increasingly foreign companies are finding it difficult, Tom, to operate there. And a story for tech, that's been a story with tech for a long time.
John, it's a huge deal, particularly with semiconductor development out of Taiwan and their excellence at it and that. But John, you've heard me say this 47 times. I want to know how the Western banks adapt to what Yahoo and LinkedIn are adapting to.
Yahoo, not the company it was. I think LinkedIn, Tom, probably the better example of what's developing over in China.
Yeah, with the Microsoft ownership, I get it. But I'm going to bring this up, and it may be 2 years too early. What do the Western banks do? The idea it's business as usual in Hong Kong, is nonsensical.
Lisa, for many people, it is not business as usual.
I wonder, though, how different it is for internet companies, given some of the restrictions we've seen from Chinese authorities in recent weeks.
Incredibly difficult.
Yes.
Is that the simple way of saying it?
That's
probably.
Good. Yeah.
Yeah. A conversation we need to continue, not just on the regulatory side, but on the demand side of that economy too. One to watch, that's for sure, into year end. Equity futures unchanged on the S&P, all-time highs in America. Heard on radio, seen on TV. This is Bloomberg.
With the First Word News, I'm Laura Wright. Shares of Tesla are falling. Elon Musk says the company has not signed a contract with Hertz yet for that record order for electric cars. Last week, the rental car company said it would buy 100,000 Model 3 sedans for $4.2 billion. That sent shares of Tesla rocketing to a record high. But Musk tweeted there was no signed agreement and that Tesla would only sell cars to Hertz for the same margin as to consumers. Today's election for governor in Virginia will offer the clearest picture yet of how much momentum Republicans have in the 2022 vote for Congress. GOP candidate Glenn Youngkin is backed by Donald Trump, and polls show he's in a virtual dead heat with Democrat Terry McAuliffe. McAuliffe is betting that the former president's legacy will turn out Democratic votes. House Speaker Nancy Pelosi plans to push forward with plans to vote this week on President Biden's economic agenda legislation. She's getting pushback from moderates who want a detailed analysis of the full cost and economic impact. That echoes complaints from Democratic Senator Joe Manchin. He says Congress needs more time to assess the bills. Former opioid makers have scored the pharmaceutical industry's first win in the 4-year litigation over the drugs. Johnson & Johnson, Teva and others defeated a lawsuit by local governments in California. The suit claimed they created a public health crisis through misleading advertising. The governments wanted money to beef up policing and drug treatment budgets. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Television and radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference, this week on Bloomberg Television and Radio.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of. Look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at you'd have to look at what was you're defining as strategic or critical.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Harmeet Singh is spearheading Levi's investments in innovation.
As CFO, the one important thing is to ensure you're able to connect the dots and always think longer term.
Watch the world premiere of Chief Future Officer this Wednesday on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
When you look at the second half of 2022, are we seeing higher prices that are now outstripping the rises that we're seeing in wages? Does that become a little bit of a spiral where we see prices and wages rising together? Or does this actually become something that's negative for demand?
That final point's the key question. Is it something that becomes negative for demand? Demand right now is robust. Andrew Hollenhorst there of Citigroup, the chief U.S. economist. From New York City this morning, good morning. Tom Keene, Lisa Abramovitz, Jonathan Ferro. Your equity market futures are just about positive, up 0.05% after a record close yesterday and a third day of gains on the S&P. Into the bond market, yields basically unchanged, down, let's call it a little bit, to 155 on 10s. The front end in focus going into the Fed tomorrow. Crude 83.50, there and thereabouts, down 0.7% on the session, on the year on WTI, Tom. Up 72% on WTI. What a move.
And some of the other commodities up 100% on a nominal basis as well over the last 4 or 5 years. Javier Blas joins us right now. Lean forward, folks. This is your energy conversation of the day. The book is The World for Sale. Blas, you could buy a bottle of Beaujolais with the book royalties, but the movie rights have been off the chart. The World for Sale winning all sorts of business book nominations and awards this year. Javier, I want to talk about the giant David Pimentel of Cornell University, their professor emeritus who did the original work with the UN on energy inputs into food. I want you to walk away from OPEC and tell me what these energy prices do to wheat, to rice, to corn.
Well, it makes, you are making a very good point, Tom. It makes food very expensive to produce because we need natural gas as a main input to produce fertilizers. And the price of fertilizer right now depends on the location that you are looking at, but is around or at an all-time high. And that means that when American farmers and farmers elsewhere need to plant the next crop, they're going to face a very steep increase in cost. It may mean that they are going to apply lower fertilizer, that it will be the case, and certainly yields will suffer as a result. So that's one reason we're going to have higher food prices.
Just because of time, Javier, I understand rice elasticities in Cambodia are different than California. We all intuitively get that. Are you framing the hydrocarbon move as a concern, an interesting exercise, or are we in some form of pending crisis linking hydrocarbons into food?
I think that we are in an energy crisis right now. The prices that we are seeing for fossil fuels across the board, not only oil at $85 a barrel, but natural gas prices, particularly here and in Asia, thermal coal prices, certainly in Asia. These are prices that will have been equal to a crisis in the past. We see manufacturing capacity being shut down in Europe because the price of energy is too high. And the same thing is happening in India and China. So certainly we are in a crisis. I would not call it yet a food crisis because the price of rice remains contained. It's so far soybean, corn, and wheat, what is where prices are increasing. If rice joins that race on food prices moving higher, I would be more concerned. A good reminder that rice is the main staple for about 3 billion people in the planet.
Javier, a lot of nations have actually said to OPEC Plus, please pump more oil, including the United States, including Japan. OPEC Plus meeting on Thursday. Why have they been so reluctant to adapt to the reality that other people are seeing, which is oil prices that are likely to keep climbing?
not only those two that you mentioned, but also India. We are hearing also that behind the doors, China is also complaining. So, as you say, a very important group of top consumers putting pressure on OPEC. OPEC is responding that the problem is not really oil, it's in natural gas and thermal coal markets. But I think that OPEC is probably missing the point to a extent. There is an oil shortage. The market is extremely tight, but OPEC is more concerned about the downside. They're worried that with the winter, we may have another increase on COVID cases, that the demand may suffer going into the future. But those concerns are for the future. Right now, there is a shortage of oil, and OPEC is happy letting the market going up.
Is there another reason? I'm wondering, Javier, because honestly, it seems like Francisco Blanch, who's actually been pretty accurate of Bank of America, came out, said he's expecting Brent crude to go to $120 a barrel by June 2022. I have not heard one person come out and say they expect a plunge in the price of oil in the near term as a result of an uptick in COVID cases. What is OPEC Plus looking at?
Well, I think that Saudi Arabia in particular is looking for, if I'm going to make a favor to you, the United States, what are you giving me in return? We have been hearing some mixed messages from the U.S. and from the Saudis about what is at play, but I think that it's a geopolitical play. The United States wants Saudi Arabia to lead OPEC to a production increase. The Saudis probably are asking something in return, probably is a better relationship between the two countries, and until that happens, I think that both sides are going to play a bit of a hard ball.
Javier, as we have higher food prices in oil, do you have a tip point on Brent? Is there a price point on Brent where the world that's been for sale forever comes undone?
I think that we are approaching the point where consumers are starting to feel the pain. I certainly myself, I was filling up the car over the weekend, and I realized how much gasoline prices have come up recently over the last 3-4 weeks in the United Kingdom. I felt like, oh, damn it, that was expensive. And I'm sure that many other consumers are feeling the same way, particularly in countries like the United Kingdom, where gasoline and diesel are heavily taxed. Prices are very high. It's between $7 and $8 per gallon, give it or take, compared to American prices on American gallons. So I think that we are approaching the point where consumers are starting to suffer, but we are not yet seeing any demand destruction that will mean that we are at breaking point. And we have seen in the past that the global economy has taken $100, $125, and demand has not suffered.
How much is a litre of petrol right now in London, Javier?
It's 143.9.
Is it really?
Per litre.
143?
Yeah, that's expensive.
Wow. 60%, 58% of that is tax? Or at least the fuel duty,
Yeah,
right? Then VAT on top.
About 75% of that price goes to the UK government rather than to OPEC governments,
Isn't
which is
that
a point that OPEC governments will make. I mean, if you want lower prices, you could lower your taxes.
Javier Blas, thank you, sir.
He's running for office there.
Tom, that breakdown there at the end, the breakdown of the price, fuel duty is about 57, 58 pence. I forget the precise number. Then you've got the taxes on top. 75% of a litre of fuel is tax in the UK.
We've got other states, I don't have it in front of me, John, but there's selected U.S. states that are on the edge of that. To bring that over, John, to the crisis at hand, then you have an entire nation like Indonesia with the size of population where the government unilaterally comes in and fixes the price of hydrocarbon.
And who wants to be seen over at Glasgow right now, Tom? Cutting fuel duty, cutting taxes on fuel.
When you got 400 Gulf Streams landing, call it worse than Davos. I don't think that's possible. But, the uproar here about, the 400 Gulf Streams is tangible.
Political reality, Lisa, this week is shining pretty brightly, isn't it?
Yeah, the idea of not wanting to seem like you're trying to foster more hydrocarbon use by reducing the tariffs and yet not wanting the political ramifications of the price of petrol.
My Bloomberg terminal lighting up now.
Is
with
it?
People writing in taxes $1 in New Jersey. Tom, a lot of people frustrated about that situation.
That they want it to be higher, you mean, right?
No, I think they feel like they pay enough taxes already over in New Jersey, maybe. Maybe that's the point they're trying to make. Futures, just about positive.
For more.
On radio,
John.
on TV. I doubt anyone's writing in to pay more taxes this morning.
The tots are paying for all of Conte's gas, petrol.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
Talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance with Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market all-time highs, 1 hour away from the opening bell. Your equity market this morning unchanged. Into the bond market, 155.40. A decision from the Federal Reserve coming up tomorrow. The Bank of England coming up on Thursday. In the FX market, euro dollar 116.8368 on crude. Fantastic to catch up with Javier Blas, the author of The World for Sale. We didn't thank him enough, Tom, in a previous segment. Absolutely fantastic. And my Bloomberg terminal did light up with people writing in about taxes in New Jersey. Tom, here's another one. I'm as angry about NJ taxes as anyone, but whoever wrote to you that it's $1 a gallon is way off. We're about 40 cents a gallon. I make it about 42 cents a gallon right now.
I suggest there's different taxes.
Over in New Jersey.
There's a sum of taxes, John.
I'm told by the individual that told me it was more than that we have gangster stations that are cheaper. Okay.
Yeah.
You really want to get into this, John?
I don't want to get into this right now
You
at all. I'm just reading verbatim what some Bloomberg subscribers are,
6 people in
writing
Garden
in.
State Parkway.
Serves me right. Yeah. Crude right now, Tom, 83.73.
Let's try to salvage the show now. We can do that with Ian Lincoln, head of U.S. rate strategy at BMO. Ian, I want to talk about the dynamics, a wicked inside baseball that you look at. What shows you in the bond market now that there are people harmed by all this volatility, all this unique uncertainty?
Well, Tom, I think there are a lot of things that we can look at in the bond market and see a fair amount of pain. One obvious aspect is the MOVE index. We've seen volatility spike. We know there are going to be people on either side of that. And in addition, if we look at some of the positional surveys, what we've seen is that to a large extent, real money remains short duration. So further out the curve, people are playing for higher rates. That means that the pain trade is towards lower yields. And that's to a large extent what we have seen as a bit of a surprise for a good portion of this year.
So what's your award-winning guesstimate of how that plays out, say, in 6 weeks, say in 2 Fed meetings? How does that play out when there's a bet, or even worse, a leveraged bet?
Well, I think there's a very strong tendency in the futures market to overprice what the Fed is going to deliver in terms of rate hikes. So right now, we have more than 2 Fed hikes priced for 2022. That presupposes a lot in terms of an acceleration of inflation that ends up being not transitory, as well as a continued improvement in the labor market with no risk from higher prices undermining consumption and weighing on spending into the holiday season. I think there are a lot of moving parts at this point in the cycle that has me somewhat skeptical that the Fed will be able to deliver in the way that the market is currently assuming.
Ian, let's sit on this idea that you said, which is the pain trade is for lower yields. How much lower, and what's the trigger?
So if we look historically, tapering announcements have been positive for 10s and 30s. So it could very well be simply the passage of the event risk presented by Wednesday's meeting that opens the path for rates to grind a bit lower into the end of the year. We still have the budget debate. We still have the debt ceiling. We have the Treasury Department expected to cut coupon auction sizes. All of this suggests to me that 10-year yields could end the year in a range of 125 to 135, and that would be very consistent with the trading environment that's been in place for the bulk of this year.
Ian, if that's the case, if we end up with a 10-year yield of 125 to 135 versus the 155 where it is right now, do you foresee that real yields will go incredibly negative? In other words, will inflationary outlook stay where it is even as we see this potential downdraft in yields?
Well, one of the fascinating parts of the price action over the course of the last 2 weeks is that at the beginning of October, we were seeing more rate hikes priced in while break-evens continued to drive higher and higher, consistent with the moves that we were seeing in energy. It wasn't until the last 3 or 4 sessions where more rate hikes had the more traditional impact on inflation expectations, and that brought break-evens lower. So I could easily envision a situation where the Fed delivers on tapering, makes it clear that the next move will at some point be a rate hike, but not imminent, and nonetheless, break-evens continue to grind a bit lower from here. So it could be that the nominal story ends up being one of curtailed inflation expectations, even as we continue to make our way out of the pandemic.
Ian, what 2-year yield signals the death of transitory? We're at 0.48%. We've been up, I'm guessing, 0.55%. What yield point on a 2-year signals the end of it all?
Well, I've been making the point that the market doesn't own the definition of transitory. The Fed owns the definition of transitory. So as long as Powell says that the influences of inflation are temporary, the market, to a large extent, has to accept that. The best that we can do is we can figure out any point at which the Fed might abandon that definition. I don't see that happening in the fourth quarter. If it were to occur, it would be a Q1 event. And at that point, we will already have 2-year yields, assuming that inflation performs in a way that would force the Fed. We will already have 2-year yields above, I would say, 60, even 65 basis points.
I look, Ian, at the bond market right now, and James Sweeney on earlier with Credit Suisse calling it a bowl of spaghetti. How do we straighten out the spaghetti? I mean, is it by Fed action? Is it by some form of market capitulation or market adjustment? Who's driving the train into 2023?
I would say that it's a classic tale of 2 markets at this point. The front end of the market is owned by the Fed, and they are setting in rate hike expectations, which will dictate where 2s, 3s, and 5s go. Further out the curve, people are worried about the impact on growth. People are worried about higher prices forcing the Fed to move more quickly than they might have otherwise wanted to move. And that's why we're seeing the bull flattening aspect of the recent price action, which implies something of, if not a policy error, then a policy misstep as the Fed tries to navigate us out of the pandemic.
So if we talk about a bowl of spaghetti, sometimes this feels like a bowl of spaghetti for me. Ian Lingen, head of rate strategy at BMO, I am curious from your perspective, as we look out into the future, a lot of people are saying the bond market is sending a very different signal than the stock market. Stocks are optimistic, bonds are concerned about this policy error, as you say. Is that the accurate way of reading this, or is it just that rates are overall going to remain lower for longer on an ongoing basis once we get over this blip, and that's supportive of risk assets?
Yeah, I think actually that your latter interpretation is correct, that we are still in a comparatively very low rate environment. And while the upside for equities might be slowing versus what we have seen over the course of the last 18 months, the reality is still that there's a solid base for risk assets to continue to perform well in this environment.
Great to catch up as always, Ian. Important day tomorrow, that's for sure. Ian Lingen there of BMO. Coming up on the Open in about 20 minutes from now, we'll catch up with Laurie Heinel of State Street about this. She is less constructive on the outlook for growth next year, Tom.
Oh, you saved the gloom for the next hour.
That's going to be part of the debate, but not everyone is gloomy. So we'll have the other side of that conversation too.
Well, there's a guest, Lisa.
Brownwitz?
Yeah, book her.
Yeah.
She'll leaven it out.
Lisa used to be a frequent guest. We can play salts from the morning, Tom.
Yeah. What's great here, I can announce this, folks. I talked to Al
earlier in the day.
Corners around them.
I talked to Al from New Jersey today, and I'm thrilled to announce, folks, look for weekend programming in 2022, The Real Teflon with Lisa Brownwitz.
Wouldn't that be good? I think I miss Lisa's old weekend show.
Thank
I think that'd be good. Just 30
The Real
minutes.
Teflon?
Just a long
Real
column.
Teflon.
Lisa just reading out everything she wants to say, and you stopped her from saying Tom.
You think it'll be only 13 minutes?
It'd be killer. I think we could edit it down, Lisa.
I could name it The Real Lisa.
26.
It could just be a highlight of all of the potential negative risks that are out there that I worry about at
round
night.
corners. All the risks just happen to be negative.
The biggest negative risk is we're all going to Davos, which will be a risk.
Are you making that announcement now, Tom?
I'm not making that announcement now. It's under negotiation.
Okay, what are we negotiating?
The Gulf Stream.
The Gulf Stream.
There's 20. Look, we don't have a 650 like Benioff. We've got the smaller plane.
Yeah.
Benioff's got 22 seats. I've got, I think, like 16 seats. I can't remember right now. We can't get Lisa's entourage on.
I'm happy to start the coverage right now, Tom. When we get out there, we have to reflect on what happened in 2020 in January when China started to shut down. And that conference, Tom, was asleep. Was totally asleep.
No, there was, I'm losing the right word right now, but you're absolutely right. Happy Valley stopped for the president of China, and maybe there wasn't enough skepticism.
Nothing, Tom. Nothing. China will handle it. China will handle it.
It was eerie how it
overwhelmingly.
stopped.
That was the consensus. It was bizarre. It was totally ridiculous. And Lisa, no one wanted to talk about it either.
No,
nobody wanted to talk about it.
But that's the reason why there is so much skepticism around COP26, right? I mean, honestly, going into this, when we talked about fluff yesterday, and you were saying, really, you think it's going to be fluff? This was the fear. And this is why you are getting announcements on specifics like methane from President Biden today. But to me, people are sort of tired of it.
For a lot of people, there's a cost of living crisis. And that's what they want to hear these guys discussing, Lisa.
Yeah, and how they're going to dovetail that into a cleaner future while at the same time people can't afford their bills. That is going to be a very difficult needle to thread.
Bramos Bears coming up this weekend.
Oh, are they? Am I
7
working?
p.m. Eastern Time. I assume you're going to record it.
When?
I don't know, at some point in the week.
Okay, thanks.
It'll work out.
You
Futures
just assign me more work.
up 3, up 4 on the S&P 500, up about 1/10%. All-time highs coming into Tuesday. There's a nice lift in this equity market. Tom, we like to give you a rest. A rest. Just a rest on a weekend. Let you watch the football.
Ramos Bears.
Tom, I'm very close to writing in to see if they'll let us guest host a Premier League weekend.
That would be fun.
Wouldn't that be cool?
I'd have to actually learn what
maybe
I'm talking about.
Maybe they'll let us do Italian football on Paramount. Because not
somebody
many people are
emailed
watching
in.
now.
Somebody, John, emailed in and said Harry Kane looks awfully good with Saudi money at Newcastle.
Oh, Newcastle. I saw that too. We'll start rumours on this show too. None of it's backed up by a source when it comes to football.
Daniel says, let's see.
What's he saying, Tom?
Daniel says no chance.
From New York. This is Bloomberg.
With the First Red News, I'm Laura Wright. The Biden administration is launching an assault on methane today. It wants to keep the heat-trapping gas from escaping landfills, oil wells, and farms. The U.S. says more than 90 nations have signed on to its joint initiative with the EU to cut methane emissions 30% by 2030. President Biden calls methane cuts the most effective strategy for slowing global warming in the near term. Hong Kong is tightening what was already one of the world's strictest coronavirus policies. It will end quarantine exemptions for senior executives, bankers, and most other groups starting November 12th. Hong Kong hasn't had a local outbreak of the coronavirus since early June. The city is counting on the restrictions to improve the chances of China opening up to cross-border travel. Port delays have gotten worse at the world's largest shipping hubs. Near Singapore yesterday, the backlog was 22% above normal. There were 53 container ships anchored off the port. That's the highest count since Bloomberg began tracking the data in April. Meanwhile, the dual ports of Los Angeles and Long Beach kept at least 79 ships offshore. Under Armour rose in early trading after raising its full-year outlook and posting quarterly revenue that beat estimates. Strong consumer demand for athletic gear offset problems in the company's supply chain. Under Armour expects revenue to rise about 25% for the full year. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case, I mean, at least in theory.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
So recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
months, the Fed decides. Will the Fed finally announce a date to start a taper? And how long will it last? Will they still view inflation as transitory? Find out Wednesday starting at 1:30 p.m. Eastern on Bloomberg.
I think there's been a big fuss made out of the front end of the US curve. I mean, I see 50 basis points for the 2-year as nothing more than a really benign reflection of where we're likely to go over the next couple of years.
Pedro Garvey, ING, what a year they're having. ING, a really nice essay I saw in the Zeitgeist today, and the Netherlands doing so well. I think Ben Laidler at eToro out with that. ING and Pedro Garvey with some thoughts there on the bond market. Lisa Bramowitz and Tom Keene with a very important conversation right now, because this is the hallmark of Barry Ritholtz. He's a piñata for a lot of people out on social, but the thing that Ritholtz does is he always backs statement with adult academic research. And for this, Barry Ritholtz goes back to someone we lost far, far too young. I remember, Barry, in 1980, the sudden death of Arthur Okun of Yale University. That it was just a shocking loss. Tell us what Arthur Okun invented to put us out of our misery.
Sure, a couple of things. He's known for Okun's law, which looks at the relationship between employment and GDP, but his big contribution to the current day and age is the misery index. Take unemployment, add inflation to it, and it gives you a state of how bad the economy is for the average person sitting around trying to buy goods and earn a living.
And he did this in the 1970s, and I do love the phrase, a dismal decade, because Barry and I lived it, and folks, I can assure you younger, it was dismal in so many regards. You're really pushing back against the gloom crew, calling this the dismal 2020s.
Yeah, the stagflation phrase keeps getting trotted out. And if you look at the data, if you look at the state of the economy in the 1970s versus today, they're just not comparable. The misery index invented by Okun hit 20 in the early 70s and then 22.5 by the end of that decade. And it averaged well over 15 for the entire 10 years. We're averaging 6, 7, 8. We briefly, for a hot minute, got over 15 in the midst of a pandemic and then collapsed back down to 10, 11.
Yeah.
There's just no comparison, jobs, wages, inflation today versus the 1970s. It's just not a serious comparison.
And Barry, I think that a lot of people have made this point, and it's largely been accepted in markets that are not pricing in 1970s style inflation in any way, shape, or form. But then how do you price in what we're seeing now, which is different, which is not necessarily stagflationary, but is inflation that's running at a higher pace than wage increases at a time when we are seeing slowing growth? How do you sort of position around that into a market that is facing a potentially more hawkish Fed?
So first, let me just push back. When we look at the 70s, inflation was faster than average wages. When we look over the past few years, wages are up. What's that? Wages are rising faster than inflation. Clearly, they're a component of inflation, but for the average person, they're earning more than prices are going up. Let's hold that aside. How do the markets price this in? Well, we're at very, very low rates, which have been really accommodative. The process of normalization, of reopening, is taking place, and we're dealing with a lot of various issues that the stock market has done a very good job of discounting off into the future. So last year, people were saying the market was crazy. This is a pandemic. It's terrible. Things will never return to normal. The market got that right.
Yeah.
And arguably, the market is getting the higher rates and modest increase in inflation, which is likely to pass as things get back to normal. I think the market's pricing that in appropriately also.
Barry, when you talk to clients who are looking to invest their money, do they seem concerned about 1970s style inflation? Are they looking for some sort of hedge to that? Do they feel pretty good, or are they basically accepting the line that Wall Street has basically come to say, which is that things are okay?
So, we get a lot of inbound calls and emails from clients because they hear something in the media or they read something somewhere.
They watch us, Barry. Barry, just say it. They watch Bloomberg surveillance and get messed up. I think.
Well, you know, when they see a well-regarded analyst from a well-regarded firm come out and say that 70s show is in reruns and we're going to go back to it, it raises concerns. The bigger issue we've been dealing with from clients is, I'm seeing nothing on the yield sign. What are my options? How can I get some yield when treasuries are paying 1.6, 1.7? And so that's the genuine, that's the real world concern of clients, not an academic, hey, this is 70s stagflation.
Barry, to vamp off Arthur Oken, his iconic 1975 paper, Equality and Efficiency. The critics to your thesis say right now we have massive inequality and we have a tech efficiency we're all dealing with. Push against that. How do we optimistically move forward in our present inequalities and with the dominance of this tech on all our lives?
So first, when I went back and looked at 10 data points between the 1970s and 1920s, they were all different except one, which was increasing levels of civil unrest, which I found kind of ironic. The thing that we're seeing from technology and inequality is that technology is making all of us more productive. During the lockdown, white-collar workers tripled their hourly output. Yeah, there was probably a little extra time that wasn't clocked, so maybe that's a slight exaggeration. They're not commuting, they're sitting at their desk earlier and working at all hours. But that said, no matter where we look in the economy, we see the benefits of technology, and even something as simple as a restaurant with the QR code, so then they change the menu without having to wait to print up new actual physical copies of the menu, to taking orders on an iPad, to showing up and just processing a credit card with an electronic device. Restaurants were thought to be immune from productivity gains from technology. If it's worked its way down to restaurants, it's everywhere in the economy. And so the inequality we're talking about, we're starting to see companies come to the realization, hey, we're getting a lot more out of each worker per hour. We could afford to pay them a little more. And that's part of the reason why we've seen this big uptake, starting with Amazon and Starbucks and Costco, but really Amazon going $15 led a lot of other companies to do that. Walmart figured out our turnover is so expensive, we're better off paying a little more, training these people well, getting more out of them. And that's reducing inequality to some modest degree.
Very good. Barry, thank you so much. Love the work here, particularly on bringing back the good work of Arthur Oken of Yale University. Lisa, you and I see headlines on Hertz and Tesla. Lisa, here's the headline. Red sticky on the Bloomberg. Tom Keene can't fit in a Tesla.
That really is the headline, not so much. Well, basically, Hertz is saying that deliveries of Teslas have already begun. There's strong demand, very strong demand for Teslas in its fleet. But this idea that Elon Musk saying that it's not confirmed yet.
I can see the canoe on top of a Tesla up to the Adirondacks. Stay with us if you're brave. This is Bloomberg.
Alberto Fernández y todos los gobiernos provinciales van en contramano de lo que dicen la comunidad científica y los territorios que están en lucha. Han profundizado el extractivismo en Argentina con más agronegocio, con más transgénicos, con más agrotóxicos, con más proyectos megamineros. Y ahora, como si fuese poco, han avanzado presentando un proyecto de ley que es la ley de hidrocarburos.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Do you see Deutsche Bank ready to pay more and pay out more in terms of bonuses for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. Different day, same story, all-time highs in this equity market. From New York City this morning, good morning, good morning. Your equity market up 2 points, advancing 0.04%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
From New York, we begin with the big issue. The central bank deluge begins.
Right now, policy is in a state of flux.
You've got central banks really struggling.
From the RBA.
Yield control abandoning was basically the first step. Now it's up to rate hikes.
It seems like the market's a bit ahead of what all the central banks are doing.
The market has undergone quite a significant front-end repricing.
If the yield curve is talking, then is anybody listening?
Central banks seem to be kind of almost following the market.
With the BOE this week,
we're going to see central bankers who maybe get a little bit too excited, validating those front-end moves.
The expectation seems to be that we will get the first rate hike.
Markets are telling us the right story.
The Fed will announce tapering.
All of these central bankers are kind of in for a difficult messaging.
We need to be braced for a period of volatility up ahead.
Policy really remains in a state of flux.
Things can change very, very quickly.
Things can change very quickly. Joining us now is State Street's Laurie Heinel, Nuveen's Brian Nick, and Eric Knudsen of Neuberger Berman. Laurie, I want to begin with you. The front end of the yield curve has been a massive story worldwide, in Australia, in the UK, in the United States as well. Australia overnight validating the move, the UK encouraging it. They'll have a meeting on Thursday. The Federal Reserve, will they push back, Laurie?
We think that the Fed is going to stick with their current communication plan, and we think they're likely to start the tapering, and that will set them up for an interest rate increase in next year, and perhaps even as many as 2 next year. So we do think that the short end is telling us the right story right now, but we also think that policymakers want to retain some flexibility. So messaging around what they're doing now and what they expect to do in the future is going to be key.
Brian Nick, your view?
Yeah, I think actually if you look at when the front end of the yield curve in the U.S. started to inflect upwards, it wasn't the last Fed meeting, it was the last jobs report. If we get more jobs reports like the one we're going to get on Friday, where the job creation is weak, but the unemployment rate is falling because the labor force is static, that's going to put the Fed in a very tough position. Because the one way when this can all go wrong is if we get out of control wage inflation and the Fed is forced to step in sooner than they would like, because you have non-transitory inflation starting to get baked into the system. The market is on to this. The question is on Wednesday, how much does Powell push back against what the markets have already priced in?
What you just said, Brian, is so important. Eric, it's not whether they hike anytime soon, it's why they would hike. anytime soon. What's beneath, what's underpinning this move we've seen in front-end rates? What would you say to that, Eric?
Yeah, what we're watching very closely and what we're noticing is that for that all of that short-end rate increase that happened last week occurred in an environment where financial conditions overall got easier. So think about that: short-term rates going up, financial conditions indices falling, and that's because of what was happening on the back end. As long as the financial conditions are easy and the Fed can say long-term inflation expectation, long-term rates expectations are accommodative or anchored or consistent with what they're doing, as Lori said, they can follow with their path and don't have to get shaken out of what they're currently doing. And this contradiction, this disconnect between overall financial conditions and frankly markets and credit spreads versus short-term rates will have to get resolved.
And so long as demand is decent, if you go through the ISM in the last 24 hours, go through the industry comments, here's a selection of a few of them. Business remains strong, customer demand remains high, demand continues to be strong. This is littered all the way through there. This is what one industry comment read like. My prediction is that 22 will be very similar to 21. Similar demand, constrained supply, restricted logistics, and rampant inflation. From your perspective, Laurie, is that how you expect things to play out through next year?
Well, we would concur with a lot of it except the rampant inflation comment. Clearly, this has been a cycle unlike any other. The amount of cash on consumer balance sheets, the ability and propensity to spend as economies reopen, we believe that sets us up for a very strong 2022. And certainly inflationary pressures are something we want to be watching, but we think that we may have hit the peak of inflationary pressures at this stage in the cycle, and that next year, while a little bit higher than the long-term averages, is unlikely to really shock the system.
Brian, reading through your comments, it seems like you agree. Looking ahead to next year, seeing strong global demand, improving supply chains. That sounds like a fertile environment for risk assets, Brian.
Yeah, we think it will be, with a few caveats. I think demand can't be anywhere near as strong as it was this year. We had the reopening around the world. We had positive demand shock because of the stimulus. Those things aren't going to be recreated, and we do know that consumers in the U.S. and around the world are spending down the excess savings on their balance sheets. So there's no way consumer demand will be as strong, especially for goods, which people are rotating out of and moving into services little by little. So as things normalize, we shouldn't see rampant goods price inflation next year. As I said earlier, if we do see above expectations for inflation next year, it's going to come from just a general sense the economy is running too hot. We have too few workers, not so much supply chain issues with manufacturing, but just too few people domestically working and earning wages and producing more for the economy when demand is still strong. And that's really your textbook definition of when the Fed needs to step in and raise interest rates. So to me, it's all about the jobs reports now for what the Fed needs to do going forward.
Payrolls Friday coming up in and around 450,000 seems to be the estimate at the moment. Eric, just going through your notes, looking at how really constructive you are on this market beyond US large caps. You've maintained an overweight view on non-US developed equity markets, overweight on EM despite the evidence that China's slowing down, overweight high yield, underweight IG. Can we just start with your underweight on US large caps, Eric? Why?
That's really a reflection of the composition of the S&P 500 index right now. It's really now become a large cap growth index dominated by technology, defensive, what we think of as long duration assets. That's also the most richly valued component of the global equity market. And given our view of moderately rising rates from here, inflation, and just to comment on your earlier quote, we wouldn't say rampant, but in 2022, we do think inflation will be above the Fed targets and major central bank targets, even though it'll have come down from current levels. You put all that together, and you do want to be overweight risky assets, but you want to have a bias towards more reflationary components of the market, that will be less sensitive to rising interest rates. And that brings us to value and cyclicals in the U.S. and on a 12-month horizon, non-U.S. stocks. And we're starting with developed markets, Germany, Japan. We're not yet there on emerging markets, but we do expect there to be opportunities in emerging markets on a 12-month horizon.
Eric, I'd just like to frame next year with you a little bit more because it reminds me of something Jay Poloski of TPW said over the weekend. 3% inflation with 4 to 5% real GDP. That's a trade he'll take any day for an equity market that he thinks is going to go higher. That resonates with you, doesn't it?
Yeah, it really gets to, 12 years from now, what will the economic situation be? It's whether it's, 4.5%. Let's say we're at 2.5 to 3.5% economic growth and 2.5% inflation, nominal growth of 6+%. rates moderately rising, inflation above trend or above average, that's an environment for you want to own risky assets. I think the biggest challenge is what do you own as your diversifier? What do you do with what has been exposure to bonds in that environment? You want to own the equities. What do you do to help hedge what we think will be an increasing volatility environment?
What should hedge that, do you think?
Well, historically, it's been government bonds, investment grade bonds. But in this environment, we've actually seen a higher correlation between stocks and bonds. We're looking elsewhere. We're looking at inflation sensitive assets, whether that's commodities or other real assets, and we're looking at uncorrelated assets that can help provide a positive return and are uncorrelated with traditional stocks and bonds.
Laurie, could I get your view on the same question, please?
Yeah, there's a lot that we would actually agree with there. Although we have soured a little bit on U.S. large cap stocks, we're still not underweight. We've actually pared back our overweight in favor of some of the other areas that Eric mentioned, for example, European equities, where we think there's just better valuations. And the next leg of the cycle may flatter Europe more than it does the U.S. But we also are very focused on this diversification issue because, as noted, the long bonds are unlikely to provide the same kind of protection. But we do still think there are areas of fixed income, certainly investment grade, where a good economic backdrop will continue to favor those companies. We also think that high yield offers some interesting opportunities as we start to see the reversion of the trend towards fallen angels as we see some of these companies get upgraded against that better macro backdrop. So there still are other things in the fixed income space that will provide that kind of diversification, we believe, as well as attractive yields.
Brian, this is difficult. What you think is the ultimate diversifier depends, of course, on what you expect the environment to look like. Brian, what is it?
Yeah, if you think the Fed's going to hike too early and invert the yield curve, you want to be on the long end of the Treasury curve, right? But that's got to be not your base case. It's sort of a risk case that you're trying to hedge against. We still like credit. We still think the economic cycle has longer to run regardless of what the Fed is doing next year. And the search for yield and the fact that we're still, even with the short end repricing, we're still can't hold 1.6% on the 10-year U.S. Treasury. So having something that gives you a little bit more yield than that, willing and able to take the risk of an economic decline, which we don't think is going to be happening next year. So if you're looking at the fixed income market, higher yielding assets seem to make more sense. If you're looking outside of fixed income and equities altogether, something that hedges against inflation in a sort of stable to low real interest rate environment, real assets look good. Real estate, infrastructure, even things like farmland can all be hedges against volatility in the equity markets if that's indeed what we get.
Farmland's not something we can all buy, Brian. What do you suggest to people out there who are watching this and hearing farmland and thinking, what is Brian talking about? Where do I go?
Well, real estate and even publicly traded real assets and infrastructure can be a reasonable substitution for that. A lot of them have relatively high yields, can be a little bit less interest rate sensitive than certainly parts of the bond market, but still give you a reasonable yield and rate of return and have some defensive properties if the economic situation is not what we're hoping for next year, 5 or 6 nominal GDP growth.
Brian Nick, Eric Knudsen, Laurie Heinel, sticking with us. I want to talk about Tesla just quickly in the pre-market. It's been trading softer through this morning off the back of this tweet from yesterday evening from Elon Musk. We're down about 3.5% now. He went on to say, just referring to the stock price move we've seen, if any of this is based on Hertz, I'd like to emphasize that no contract has been signed yet. Tesla has far more of a demand than a production problem. Therefore, we will only sell cars to Hertz for the same margin as the consumers. Hertz deal has zero effect on our economics. He's alluded to something like this before. The new piece of information here is that we haven't signed a contract yet with Hertz. And Hertz this morning don't directly address these comments on Twitter this morning. What they do say is there's very strong early demand for Teslas in the fleet. The deliveries of Teslas have already started. We're going to head out west to Ed Ludlow, to the West Coast, in about 20 minutes' time to get his thoughts on this. This stock is down about 3.8% after rallying more than 50% from October. Little more than a month, up more than 50%. Unreal rally. Coming up, Senator Manchin slamming the brakes on the Biden agenda yet again.
For the sake of the country, I urge the House to vote and pass the bipartisan infrastructure bill. Holding this bill hostage is not going to work in getting my support for reconciliation.
It's Groundhog Day down on Capitol Hill. Democrats divided. That's next. This is Bloomberg.
energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic, and there are a handful of things going on. I think all over the world, there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I will not support the reconciliation legislation without knowing how the bill will impact our debt and our economy and our country. And we won't know that until we work through the text.
Senator Manchin pressing pause once again on the Biden agenda, looking for a full economic analysis before pledging his support for reconciliation. The White House Press Secretary Jen Psaki responding in a statement with the following: "It's fully paid for, will reduce the deficit and brings down costs for healthcare, childcare, elder care and housing." For more, Bloomberg's Emily Wilkins joins us now from D.C. Morning, Emily.
Good morning, Jonathan. So, yes, we're sort of seeing these very interesting dynamics evolving on the Hill. Senator Joe Manchin coming out. We already heard what he said yesterday. What was perhaps almost just as interesting was what progressives responded with. You know, last week we heard them say they wanted an affirmative yes from Senator Manchin and Senator Kirsten Sinema. But yes, last night they said that they would be just fine moving ahead, voting on both bills, so long as President Biden could guarantee that he will eventually get all the Democratic senators on board. That's a bit of a softening of their position, but one that could mean that the vote could wind up happening this week on both the social welfare and tax bill as well as the bipartisan infrastructure bill. There are serious concerns, though, that we're seeing from moderates, not just Senator Manchin, but also moderate members of the House, saying that they do want to see more information on this, such as a score from the Congressional Budget Office, which reviews legislation and says, hey, this is how much money it would spend, this is how much money it would raise. So those are a couple things we're keeping an eye out for. Speaker Nancy Pelosi told us last night, reiterated this morning, that they are on track to get a bill done this week with a vote that could come as early as Thursday.
Emily, the focus in markets almost exclusively on taxes. This just dropped from Bank of America on what could go right for the S&P 500. Part of that is taxes. They say the tax hit is manageable at 1 percentage point of earnings. I'll read it through for you. A watered-down infrastructure spending plan, $1.7 trillion, has Dems slimming down the proposed tax bill to just 15% minimum, a 1% tax on corporate buybacks, translating into a 1% hit to EPS versus the previous bill's estimated 5%. Emily, I won't get you to break it down what you think it means for the equity market. What I'm interested from your perspective, have they finished negotiating the tax side of things? Is that done? Is this it?
For the most part, we're not hearing any new debates on the taxes, except for save those SALT taxes, those state and local taxes. There are still a number of lawmakers saying that they are pushing to get that into the bill. They believe it will be in the bill. It's really just a question of what it will look like. Same thing with other elements on the bill. There's the element with immigration, the element on prescription drug pricing. Those aren't set in stone yet, and really until they actually have a bill that they can say, hey, this is it, it's going to the floor, elements can absolutely change between now and an actual vote.
Emily, just a final word on the main event, really, politically speaking, here in the United States. It's in Virginia, right? Can you walk us through it?
Yeah, so the Virginia gubernatorial race is being closely watched right now because Virginia is traditionally a swing state. You have a lot of Democrats and a lot of Republicans there. Another interesting aspect about Virginia is that it tends to be really indicative of how the midterms might go. And right now it's a very, very close race. You have Democrat Terry McAuliffe, Republican Glenn Youngkin running very closely with each other. And the results of this race are really going to inform how lawmakers view the upcoming 2022 midterms, give Democrats a sense of how much trouble they might be in, given that they're already facing a tough midterm, and give Republicans a sense of how closely or not so close they want to keep former President Donald Trump.
Emily, thank you. Emily Wilkins there, down in D.C. on some of the big events down in Washington at the moment. What does it mean for this market? Here's the view of Academy's Peter Cheer. Take a listen.
I'm actually thinking we're not going to get a positive bump in Q4. I think we're actually going to see some very disappointing data because I believe so much consumer spending was pulled forward. That's going to be a problem. And the stimulus package, which I was hoping was going to be very positive, seems going to marginal probably at best.
Sometimes for markets, you don't need a tailwind, you just need the absence of a headwind. Is that what we get from Washington? Laurie Heinel, Brian Nick, Eric Knudsen. Laurie, your take on that, what you expect from Washington looking ahead to next year. I often ask guests this, we've all got a view on next year. What's the fiscal point that underpins that view?
Yeah. Well, at the margin, we think it's going to be, a big package, right? Whether it's, 1 trillion, 2 trillion, or 3 trillion remains to be seen, and how it gets paid for is also something that we'll be watching very closely. But at the margin is a bit inflationary, both in terms of the spending as well as in terms of the tax policy. And at the margin, it just continues to sustain what we think will be a very strong economic backdrop. But it also comes with some risks that there's somebody to pay down the road, as these are largely deficit finance programs.
Do you assume the tax negotiation is done here, Laurie? Do you assume that's done, dusted, dealt with?
We've seen this picture before, that it seems as though everything has been solidified, and at the 11th hour there are some changes, and certainly there are international things to consider here as we think about things like minimum taxes globally. There are things related to how higher earners get taxed. There are things related to business taxes. So we think there's still a lot on the table, in spite of the fact that many of the core issues seem to be coming to a little bit more of a consensus.
Brian and Eric, I'd like your response to that as well. And Brian, I'll just share with you the view from Bank of America, and you can respond to it. A watered-down infrastructure spending plan as Dems slimming down the proposed tax bill to just 15% minimum, 1% tax on corporate buybacks. Their translation, their calculation, a 1% hit to EPS. Does that sound right to you, Brian?
Yeah, I think what you said earlier is spot on. The worst case scenario for markets for this tax bill was something where there was a much larger increase in the corporate tax rate. That was really priced in until very recently, really until I think Senator Sinema came out demanding there was no hike in the corporate tax rate as part of this bill. Also, investment taxes. All the questions I was getting from investors earlier this year were, are capital gains or dividend rate taxation, are those going to rise for high earners? The answer, it seems like in this bill, is no. So we've really kind of divorced a lot of the potentially negative effects of the taxation parts of this bill from the markets. And I think that's partially responsible for this melt up you've seen throughout the month of October and so far in this very early November, that the markets are breathing a bit of a sigh of relief on the taxation. On the spending side, these bills were never about stimulus. They were about investment on the one hand and then income redistribution on the other. And that's really what I think is going to be the proof's going to be in the pudding for how that works down the road, but it's not going to be stimulus.
Just to pick up on the second to last point there, Eric, do you agree with that? That part of the reason we had a monster October is down to what we won't get in Washington?
Yeah, absolutely. That some of the more market negative aspects of the legislation were being kind of squeezed out on the tax side. Some of the high level spending numbers in terms of potential impact on inflation. Although I would agree with Laurie, I don't think the sausage is done being made. It's gonna take somewhat longer for this all to be resolved, and that leads to what we think will continue to be some short-term volatility in markets. And then going into 2022, our biggest concern is that especially at these levels, we have seen peak fiscal. The kind of second derivative, or the change in fiscal, is going to start. It has been and will be negative going into 22, even though the absolute numbers will be positive. So that pushes the focus on the consumer. Can the consumer pick up the spending? They appear to be. They're back to kind of long-term trends. But the other side of that is that these will continue to push on some of the inflationary challenges, which are really supply supply side driven. And central bank policies are not really focused or able to address supply chain or supply side sources of inflation, and so that could continue to kind of push forward some of the challenges we're seeing on the monetary policy side.
Eric, sticking with us, Eric Knudsen there, Brian Nick, Laurie Heinel. Want to pick up on the Tesla story just briefly if you're just tuning in. A really, really small move relative to the monster move we've had through this year, and particularly through October. We're down about 3.28%. This off the back of a tweet from Elon Musk himself saying, if any of this is based on Hertz, I'd like to emphasize that no contract has been signed yet. He said the next bit before, I'll read it again, we have more of a production problem than a demand problem at Tesla. Not new, you're familiar with that. But this idea that they haven't signed the contract with Hertz, a $4 billion plus deal with the company, Hertz out this morning with a statement to us here at Bloomberg that they're already receiving cards under its plan to add 100,000 Tesla electric vehicles through 22. This one's confusing. We'll catch up with our reporter Ed Ludlow around the opening bell on this and talk to him about a whole lot more. Your morning calls are next, and later, Tesla is facing a new competitor. We'll get to Rivian Automotive preparing to go public very shortly. From New York, this is Bloomberg.
Its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Looking to build on a 3-day winning streak on the S&P 500. All-time highs into Tuesday, dead flat this morning. About 5 minutes away from the opening bell. We're positive, not even 2 points. That's the price action. Let's get you some morning calls. Atlantic Equities downgrading Expedia to neutral, seeing limited upside amid mixed travel market dynamics. Their stock is down 9/10. Deutsche Bank initiating coverage on Microsoft with a buy, 390 price target. Calling it, quote, the gold standard of software names. We're positive there, 1/3 of 1%. And Jefferies upgrading Alcoa to a buy, seeing a more positive outlook for aluminum, aluminium, tomato, you get it. With the global push for decarbonisation intensifying, we're positive there, 1/3 of 1%. Coming up, the Hertz versus Tesla confusion taking another turn. That conversation's next. Your opening bell just around the corner from New York. This is Bloomberg.
past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 seconds away from the opening bell in New York City this morning. Good morning. The two-day Fed meeting begins today. I assume they'll wake up at some point in the next couple of hours in Washington. Different lifestyle compared to here on Wall Street, as you know. Futures on the S&P 500 up 2 points, advancing 0.04%. There's your opening bell. Switch up the board and get to the bond market. The focus of the Treasury market, not on 10s, where we're at 155.76, but on 2s, where we're in and around 50 basis points, repricing Fed rate hikes and pulling them forward materially over the last month or so. In the FX market, euro dollar 115.97, negative there about 0.1%, and crude down 0.8 to 83.37. In the early part of the session, here's your S&P 500. 3 days of gains into Tuesday, we make it 4. We're up about 0.1%. Real estate top of the pile up by 0.4%, call it 6. At the bottom of the pile, discretionary, consumer discretionary down about 0.9%. If we can get to Tesla and get an early look on where that name is trading right now, that stock's been softer all through the morning. It's a little bit softer around the opening bell as well. We're down there by 4%. Hertz is down by about 3.32. The confusion is around this tweet from Elon Musk. Elon Musk saying earlier yesterday evening, if any of this is based on Hertz, I'd like to emphasize that no contract has been signed yet. Tesla has far more demand than production. Therefore, we will only sell cars to Hertz for the same margin as the consumers. Hertz have gone on to say in a statement to us, as we announced last week, Hertz has made an initial order of 100,000 Tesla electric vehicles and is investing in new EV charging infrastructure across the company's global operations. With this story, Ed Ludlow on the West Coast. Ed Ludlow, this one confusing everybody.
All it takes is a tweet, John. You know, we're at $1,200 a share of Tesla, close of play Monday. And Elon Musk is making the point, right, that Tesla is a supply-constrained business. This is not new. He's mentioned it time and again. Their problem isn't demand. It's their ability to build enough vehicles and then deliver them in a timely fashion. That's why 2021 into 2022 was such a key period, because you have the new factory in Berlin coming online to service local demand in Europe and the new factory in Austin coming online. So this isn't hugely surprising, but you can see the market reacting there. Tesla down by almost 5%. Come with me into my Bloomberg terminal and look at this chart, because this deal with Hertz, whatever it is, fleet deal, retail deal, it added a lot of market cap to this company, right? Almost $300 billion. You can see on the right-hand side of the screen the drop-off reflecting Tuesday's trading, because this was a point of differentiation. It was something Tesla didn't have to date. They had a direct-to-consumer business, not a B2B business. But apparently this is something that Elon Musk is refuting.
I don't want to make too much of a big deal of the stock move, Ed, because, as you know, down 2.7% compared to where we were in October is nothing. Let's make a big deal of the market cap of Rivian that's coming to market today.
Yeah.
This is unreal, Ed. Here's a company that only started delivering in August. market cap of 60 billion. Seriously?
Yeah, this is a company that's literally built a couple of hundred units of its debut EV. They're seeking a market cap of around $53 billion. If you take into consideration the RSUs and options, around $60 billion. We reported in August when they filed for IPO that they were targeting a valuation of $80 billion, 80. So there's been some natural settling of that valuation, but there's demand there. You have names like, you know, Blackstone, you have names like Franklin Templeton committing to buy $5 billion blocks of the IPO shares. At that valuation, you can see where Rivian sits versus the world of existing publicly traded automakers, right? This is astonishing, but they've built a big reputation. They raised $10.5 billion before filing to go public from big names, you know, from some of the biggest names on Wall Street, essentially. And they've got the backing of Amazon and Jeff Bezos, which is worth its weight in gold. You can see there, each round it's raised, the new and higher valuation assigned, that's the share price for each of the private rounds. And, you know, yes, right now, they are doing modest production. We reported that actually they're suffering from supply chain and prioritizing a battery electric delivery van from Amazon. But as I've reported, John, this is a very prudent company. They've taken their time. They've hired a lot of key talent from Tesla, from JP Morgan for their CFO. And by all accounts, what I'm hearing is they're ready.
Ed, thank you, sir. Looking forward to the coverage through the day. Ed Ludlow on the West Coast on this Rivian IPO. Just one name I want to talk about briefly, Under Armour, up around about 15%, a beat and a raise from them. The earnings so far have been really quite decent. Stifel's Barry Bannister's been weighing in on the recent investor pushback for IPO valuations. He says the following: US liquidity peaked in March 21, and there is less appetite for speculative equity issuance, especially with futures showing a Fed rate liftoff in 22. We don't see that with Rivian so much, do we? Laurie Heinel with us now, Brian Nick, Eric Knudsen. Brian, can you weigh in on that? That we're about to get a car company that has hardly delivered any cars come to market with a valuation of $60 billion. The reason I bring this up, Brian, is because some people find evidence of a roulette wheel spinning and start to think about the whole room being Las Vegas, a big casino. Is this just a little pocket of things that don't make too much sense right now, Brian, for you, or evidence that there's something bigger going on?
I think if there's something bigger going on, it's the markets looking forward into 22, 23, 24, and realizing that we're not going to get 50% S&P 500 earnings growth in perpetuity. The 2021 is an extremely special year because of the recovery from the pandemic, and that moving forward, if we're getting average earnings per share of 6 or 7 or maybe 8%, if we're reaching a little bit above trend, well, that's not going to deliver the same kind of overall market returns that we've become used to the last couple of years. And so I think folks are maybe rationally reaching for higher growth ideas, higher growth options. We know from the pre-pandemic period that a lot of years it was really only those higher growth stocks that were working as the economy was slowing down in the face of, yes, Fed tightening. So I think that's, you know, this one individual story is maybe unique, but I think overall we should be seeing investors reaching more for growth next year because not everything is going to be growing as fast.
Laurie, that point, when growth is scarce, pay up for growth. Does that make sense?
Well, that certainly is part of it, but I think it's also the confluence of a variety of other factors. The rise in thematic investing, and this is, you know, EVs is one of the big thematics along with robotics and biotech and things of that nature. You've also got the democratization of some of these almost venture capital-esque kinds of investments, as, you know, we've seen the SPAC market become very, very frothy, as well as just, you know, platforms, ability to trade, and investors having time on their hands to actually participate in some of those meme stocks, so to speak. So I think it may be partly reaching for growth, but I think it's also a confluence of some of those other factors.
Laurie, I want to pick up on those other factors as well. I have a ton of respect for Stifel's Barry Bannister, and I'll talk about this with him the next time we talk. But he links this speculative story with where the Fed has been. And I just wonder if that stacks up for you, because one of the most speculative periods we've ever seen in this equity market, we actually had a tightening cycle of the Federal Reserve into 2007. And I do wonder how strong you think there is some causation there between where the Fed is positioned and what we're seeing in the equity market in these pockets.
Well, there's no question that one of the big things that the Fed easy monetary policy has done in spades is to continue to push investors out the risk spectrum, whether it was their bond buying programs, which encouraged investors to go and reach for yield, or whether it's ultimately easy monetary policy that inflates in many respects the values of stocks and long duration stocks in particular. So there's no question that the Fed has been quite successful in driving investors into riskier assets as part of its accommodative policies.
Eric, your thoughts on this? Let's start with whether this is speculative activity. that we're seeing. I'm not going to sit here and say that the Rivian story won't work out. I sat here and was very, very skeptical about Tesla over a series of years, and that story, that stock, has blown up in a really positive way. So I just want to understand from your standpoint, Eric, whether you see this as very speculative. Do you see some of this as highly speculative?
I think there's definitely an element here that has to do with very easy financial conditions. And I think that that is to the extent that there's a comparator to 2007 or 1999, I would agree that the Fed is going to be paying attention to financial conditions. If they start tightening, we think they will, potentially do less tightening themselves. We're taking the under in terms of what's priced in terms of the Fed tightening in the next year or two. I think the other part of this, though, is a reflection of kind of the evolving global economy. Kind of net zero and decarbonization is going mainstream, and government policymakers are indicating, to a certain extent, winners and losers, and investors are following, that trend towards electric vehicles over traditional vehicles, et cetera. I think these are key themes, as to echo Lori's point, that I think are going to be driving markets for years to come.
Do you feel pushed into those themes right now, Eric? Does it feel uncomfortable to be pushed into these themes?
The market feels uncomfortable every day, Jonathan. I said, you indicated we're underweight large cap growth. So,
yeah.
We're saying we want to be underweight Tesla at this juncture. But I think it gets to the notion that as Elon said, they have a supply problem, not a demand problem. That gets to the challenges associated with supply side inflation. And the fourth major macro theme we're facing, looking for is volatility. And you just saw it in Tesla stock, and we think we're going to get more of that. But we think that volatility is going to give us opportunities to buy risky assets at better entry levels to take advantage of kind of the next 12 months opportunity set.
What we don't have is an earnings problem, at least so far. Here's the view from Morgan Stanley and Mike Wilson. And Brian, I'd like your response to this. Enjoy the treat for now, but there's always a trick. Beware the trick and manage your risk accordingly. We think the earnings growth slowdown will be worse and last longer than expected as the payback in demand arrives early next year. Brian, Nick, your response to that, please.
Yeah, I think the slowdown in earnings in 2022 is largely baked into the cake. I mean, we've seen these revisions, positive revisions for this year. We've seen negative revisions for next year. So I think that's something the markets already understand. In terms of the consumer demand, the fall in disposable personal income, a lot of that's coming from the government side. So we had a 7% decrease in transfer payments in the month of September. That was because of the unemployment insurance expiring. So as the consumer becomes incrementally weaker, even if private sector wages and salaries are moving up and supporting them, even in excess of inflation, the demand side of this is going to fall, I think, not quickly, but steadily throughout 2022. And that's going to feed through into earnings as well, even if we get the supply chains completely sorted out.
And this is what I love about the outlook for next year. I can't find a consensus right now. There's so much division out there at the moment. We had Francis Donald on the program with us earlier this morning of Manulife, who called it the anti-forecast looking ahead to next year because the range of outcomes is so wide. I mentioned Morgan Stanley, Laurie, concerned about what could happen with the earnings profile of the S&P 500 into next year. Here's Salita Marcelli of UBS, and she says the following. We remain comfortable with our expectations for S&P 500 profit growth of 45% this year. Our outlook for continued earnings growth in 22 is a key driver of our expectations for further equity market gains. Our S&P 500 target for December 22 is 5K. They're not alone, Laurie. Where do you come down on this?
Well, look, we may have hit peak earnings growth, but that hardly means that we've reached peak earnings. So we do expect earnings to continue to come through in 2022. And interestingly, we also are looking at quality and valuation. So that leads us to look at other parts of the market, such as small caps, such as Europe, for example. So don't count out large cap US, but look for quality and look for sustainability there, not just hyper growth.
Laurie Heinel, thank you, alongside Brian Nick and Eric Knudsen. Guys, thank you for working through the opening bout with us about 11, 12 minutes into the session. Coming up, investors seeing a tough balancing act for Chairman Powell.
Most of the time we would say, don't pay attention to who's running the Fed, focus on the data, except that right now the outlook for the Fed is very binary.
That conversation up next. This is Bloomberg.
Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference, this week on Bloomberg Television and Radio. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Harmeet Singh is spearheading Levi's investments in innovation.
As CFO, the one important thing is to ensure you're able to connect the dots and always think longer term.
Watch the world premiere of Chief Future Officer this Wednesday on Bloomberg.
It's a very difficult position for them to be in, right, because of their dual mandate. We have very weak labor force participation. They want to encourage full employment, but inflation really seems to be picking up, and it doesn't seem to be nearly as transitory as we had hoped.
Investors looking for the Fed to validate November tapering calls, this amid lingering inflation concerns and pulling forward rate hike expectations. For more, let's bring in Bloomberg's Mike McKee. Morning, Mike.
Good morning, John. You've underlined the difficulty of the Fed's task tomorrow. They've got to convince the markets that they're not going to let inflation get out of control. Obviously, they're going to start tapering. That's baked in. But it's going to be in the statement in Jay Powell's news conference that news will probably be made. They got to take a look at the way they frame inflation. It's probably too much to ask them to drop the word transitory. But they may reframe this statement because inflation has not been transitory. They may keep the word in there, but say something about how it has lasted longer than they expect. And then what happens if it doesn't go away as the Fed does expect? And they're on a preset tapering course. Well, they've said in their statements that they will be prepared to adjust the stance of monetary policy if risks that could impede the attainment of their goals come up. So expect them to underline that, emphasize that, maybe use a little bit different language, but let people know they are going to be on top of inflation as they head into 2022. And all that leads us to what the markets think. You showed at the top what economists think. In the last month, the markets have priced in not just a move in July of 2022, but 2.5 moves by the beginning of 2023. Remember, we weren't supposed to have any rate moves, John, until 2023, and now we're looking at almost 3 before then.
Yeah.
They've got a communications job with the markets.
We'll get to the language issue in a moment. You used the phrase there, Mike, that got my attention, and we've been talking about it early on this week. Preset. How much of what will be announced tomorrow will be preset?
Well, it's going to be preset. They want it to be preset. They want it to roll off without any issues, because changing it, I mean, if you pull forward the amount of tapering you're going to do, then what happens? You get a taper tantrum, you get the markets immediately reacting with higher rates. If you push it back, maybe you get the same thing, because then everybody starts to worry about inflation. So if they can set a calendar and hopefully keep to it, that's their goal. We should expect about $15 billion a month.
This is a tough one for the Fed tomorrow and for Chairman Powell. This is the quote that came from the team over at Bank of America. They write the following: "We see risk Fed comments are interpreted as hawkish due to the recognition of upside inflation risk, faster taper pace, and potential future balance sheet reduction. This could sustain or extend the recent curve flattening trend." I assume they're alluding to the move we've seen at the front end of the curve. And Mike, for me, this is interesting. I'm not going to win many fans with this, but something that Adam Posen said got my attention. I'm sure it got yours, at the Peterson Institute. He said that maybe the Fed shouldn't be making excuses up for this. They should welcome it. They should say this is the objective. We were looking to get inflation back to where it is right now. What would you say back to that, Mike?
I agree in the sense that that is true. That is what they wanted. And the thing that is interesting is how everybody's reacting to the moves in the break-evens as if they're terrible news. And really, all they're doing is starting to get out of the deep hole we were in because of the pandemic and back to where we were going into 2020. So do we go on from there? That's going to be the Fed's task.
So where did this all get lost, Mike, for you, from your perspective? Because when you frame this, they've got to defend how they're going to control inflation. That's a narrative shift. Once they start approaching and addressing that argument, they've already lost, haven't they?
Yeah, well, a lot of it has to do with the fact that what the Fed rate is affects what your return is going to be in the financial markets. And the markets don't want to see the Fed raise rates, but they don't want inflation even more. So they're trying to figure out a middle ground. The Fed's trying to figure out a middle ground. And we'll just have to see how it plays out with inflation over the next year.
Mike, messy, really messy. And then once we get through that, it's on to the Bank of England on Thursday, which we've been told is a live meeting.
We'll have fun with that one, yeah.
A live meeting, the chief economist, Hugh Pill there. Mike, thank you, sir, as always. Didn't even get to the RBA with you, though. People can read about that themselves. Abandoning yield curve control, no longer 0.1%. The market has done that for them in the last month or so. Let's get you some sector price action, all-time highs in this equity market. To break it down, here's Kriti Gupta. Hey, Kriti.
Well, good morning, John. Leading the way higher, of course, by big tech. That outperformance, that defensive bid really higher on the day. You also have those yielding sectors in the green, sectors like real estate, utilities, even consumer staples now flat on the day. Once again, ahead of the Fed. Completely natural to see this on the day before. Bottom of the pack, consumer discretionary dragged down by autos and specifically by Tesla after saying its contract with Hertz has not been signed yet. Now, of course, automakers also broadly getting weighed down by what's going on in the commodity space. You have metals down broadly after China imposed curbs on production throughout 2021, eyeing 2022, restrictions and limits getting rolled out even more frequently. And of course, we are still talking about the economic growth headwinds, how much capacity is really at risk with the supply chain concerns. Iron ore futures extending losses below $100 a ton. And with that, mining and steel stocks like U.S. Steel and Nucor dropping in sympathy.
Kriti, thank you. Thank you very much. Let's turn back to that story that Kriti mentioned. Tesla, that stock fit in the gap. A small move lower. We're now negative about 0.75%. Elon Musk overnight saying the following: if any of this is based on Hertz, I'd like to emphasize that no contract has been signed yet. We have more of a production problem than a demand problem. Therefore, we will only sell cars to Hertz for the same margin as to consumers. Okay, we get that. But this is what Hertz had to say, and some fantastic reporting has come from the team that Eric Schatzker's been leading here on Tesla. This was the statement delivered to us this morning from Hertz. As we announced last week, Hertz has made an initial order of 100,000 Tesla electric vehicles and is investing in new EV charging infrastructure across the company's global operations. Deliveries of the Teslas have already started. We're seeing very strong early demand for Teslas in our rental fleet, which reflects market demand for Tesla vehicles. Demand is decent seems to be the takeaway. For all the drama of the last, 12 hours, this stock is down just 0.6% after a monster rally, not just over the last several years, but through October into November. The stock is down 0.5% now. Coming up, the market moving events you need to be watching. It's our trading diary into Friday. Before we get to payrolls, we've got to get to the Fed, then to the Bank of England, then to payrolls, and then hopefully you can have your weekend. From New York City, all-time highs at a 4-day winning streak on the S&P up 10. We advanced 0.2%. This is Bloomberg. 25 minutes into the session in New York, fourth day of gains on the S&P, another all-time high. We grind another one out, up 0.2%. Let's call it a quarter. That's the equity market on the S&P 500, all-time highs, all-time highs. You're used to this, aren't you? Switch up the board and get to the bond market. I want to talk about the front end of the yield curve, starting in Australia, where they validate the move we've seen, yields higher, by abandoning yield curve control. To the UK on Thursday, where they've encouraged the move, yields higher as they start to talk about a live meeting at the Bank of England. And in the middle, the Federal Reserve, the two-year yields approaching in and around 50 basis points. We come down 2 on a session, but higher over the last month. As we anticipate Fed rate hikes, will the chairman of the Fed push back? I keep saying this. We validate the move in Australia. We've encouraged the move in the UK. Will we get some pushback from Chairman Powell tomorrow? Let's get to your trading diary. That's the price action. Looking ahead to the president speaking from the COP26 conference throughout the day, plus some key elections in the United States, including races in Virginia and New Jersey. The focus on monetary policy continuing on Wednesday with a Fed rate decision and Chairman Powell news conference. Then it's the Bank of England's turn on Thursday. And finally, we round out the week with one of the main events. It's Payrolls Friday in the United States of America. Is the next 3 days enough for you guys? What a lineup we've got. Looking forward to covering it with you. Thank you very much for choosing Bloomberg TV from New York City. This was the countdown to the open. This is Bloomberg. From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first a health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
So there's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for
Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFaul.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends.
But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia a regional power. Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
U.S. elections.
Yes.
the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, come to us say, 24 people went for the job. 73 people accepted. I was the only one guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你早。但是玩信息玩软的，中国人的脑袋绝不比你们长。我们在座的所有人的脑袋绝不比你们长。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma is an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different...
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, ValueAg, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.